Ever heard of the Buffett Indicator? Well, it was designed by, you guessed it, Warren Buffett, and is a fundamental metric designed to tell investors whether stocks are overvalued or undervalued. Is it a good time to be investing or a bad? Now, Warren Buffett has been using this for decades, and the formula is pretty straightforward. It is the market cap over GDP. So it takes the total value of all publicly traded U.S. companies, in other words, the value of the entire stock market, which today is around $63 trillion, and divides that by gross domestic product. What is the total value of goods and services we as U.S. workers produce each year? Now, over the years, Buffett has shared his guidelines for what he believes to be under and overvalued, and here are those metrics. Anytime this ratio, the market cap over GDP, is below 85%, he believes the market is significantly undervalued. Investors should be heavily investing. 85% to 109 is modestly undervalued. Fair value he finds in that kind of 109 to 134%. But over that, we start getting overcooked. According to Warren Buffett, a ratio between 134 and 158% is modestly overvalued. And any time the U.S. market cap is more than 158% of GDP, he believes the market is significantly overvalued. Well, here's where we stand today. A little bit over 200%. In fact, it's the highest reading we've ever seen. But should this worry you? Should you be panicking and selling your stocks, going to cash and gold? Or do we need to take this in context? Well, there's a couple of things that are left out of this. One of them being interest rates. You see, valuations of stocks are highly correlated to interest rates. When bonds are only paying 1, 2, or 3%, stocks are valued much, much, much higher because the earnings yield can be much lower to still be competitive. Alternatively, back in the 80s, when interest rates are up at 14 and 15%, stock valuations were very low because they had to be in order to compete with 15% fixed interest. Now, if we look at this chart, again showing the this Buffett indicator ratio over the last, call it, I guess it's about 50 years, you'll notice the last big peak was here in 2000, around 140 or so percent. But when you look at today versus 2000, well, number one, interest rates are much lower than they were there. We're also expecting them to continue lower by probably 100 to 200 basis points over the next 2 years. And that, of course, is going to affect this valuation and how relevant this model is. His model also does not account for growth. You got to remember, when Warren Buffett started investing, when he got in this game back in the 50s, it was a very different universe, okay? You could look at stocks based on what their earnings have been in the last 5, 10, 15 years and pretty much expect them to stay constant. Back when you're investing in railroads and Texas Instruments and those kind of companies. But this is a totally different world now. And what the 2000 model did not take into effect, and why it has turned out stocks were in fact not necessarily that overvalued back then, is that it was not accounting for the growth of the internet boom that was coming. And the internet has vastly changed not only our everyday lives, but the entire business infrastructure of the world. Workers are more efficient, produce far more goods and services per work hour. And today, similar to what we saw back in 2000, we've got this massive boom in the form of artificial intelligence, which is projected to vastly increase our efficiency, production, and output. Plus, and I hate to even ask this question, but is Warren Buffett even still relevant? Has the Oracle of Omaha lost his edge? Obviously, we know his prowess as a long-term investor. And if you go back 40, 50 plus years, investing in his fund, Berkshire Hathaway, would have significantly outperformed the stock market. But over the last 10 years, that is no longer the case. In fact, the NASDAQ index has outed Buffett by a pretty decent margin over the last decade. Buffett doesn't even invest in many stocks anymore. The big secret about Berkshire Hathaway is he really only has about one good pick per decade. The legacy of Buffett started with one of his first picks, which was Geico Insurance Company. This was a tip from his mentor, Benjamin Graham. He went heavy into this in his small fund, and the stock ran 48,000%. Didn't really matter what he did with the rest of the money. He was going to see fantastic results from this one pick. Later, it was Coca-Cola. American Express. The last stock he's bought in this decade has been Apple, which he loaded up on in 2016 and 2017. And despite all this AI boom and the tech revolution and all the advancement and growth in the U.S. economy, he has failed to make any significant purchases during that time. In fact, Buffett is sitting on record amounts of cash. As of last quarter, Warren Buffett's Berkshire Hathaway sits on $325 billion in cash. Now, I understand you think stocks are overvalued. You want to put a little bit of cash aside to buy something when prices come down. But this man's been building a cash pile for the last decade. 50, 100, 200, $300 billion of investor money sitting on the sidelines, doing nothing. Does he still have it? Does he still have the magic touch? Look at some of the companies he could buy in full with that money. You're telling me Netflix's future cash flows are worth less than your cash position? You're telling me you'd rather have a mountain of cash than to own Salesforce or Adobe or AMD or McDonald's or Alibaba or Disney? With the cash Berkshire has on hand right now, it could buy Zoom, Target, the New York Times, Twitter, Ford Motor, Starbucks, and still have money left over. So is this the person we want to listen to? Then, of course, there's Buffett's questionable personal decisions. Supported Hillary in both of her campaigns. Champions higher tax rates on Americans, which, of course, is an easy thing to do when you have more money than God, and there's no tax rate that could diminish your quality of life. He's even buddied up with Bill Gates and dedicated the vast majority of his net worth to the Bill and Melinda Gates Foundation. But here's a story you may not know. You see, when Warren Buffett and Bill Gates first became friends, Warren consulted him regarding his highly concentrated position in Microsoft. The bulk of Gates' wealth was tied up in Microsoft stock, the company founded. Buffett talked to him about diversification, how we do better holding a basket of diversified U.S. companies. So Bill Gates opened what's called a family office, hired a group of people to manage and diversify his assets. And today, his net worth stands at around $138 billion. But had he not listened to Warren, had he left his money in the company he knows best, the company he founded and believed in fully, Bill Gates would have been the world's first trillionaire. So in this case, at least, Warren Buffett's advice cost the man roughly $900 billion. Now don't waste your time feeling bad for poor little Bill Gates. This is the same man that called India a laboratory for testing things, referring, of course, to the vaccines he doled out by the millions with mixed results. This is the same man that had a close personal relationship with Jeffrey Epstein, and this ended up being a large contributor to his divorce from Melinda Gates. That, and of course, his annual week-long vacation with his ex-girlfriend, the naked pool parties with strippers, and a slew of other reasons that we don't really need to get into. Plus, Bill's doing fine. He currently owns 5 mansions, worth a total of $227 million. This is his primary residence, known as Xanadu in Medina, Washington, a 66,000 square foot fortress with a swimming pool with underwater music system, a 2,500 square foot gym that I don't believe the man has ever used, 6 kitchens, 24 bathrooms, and a partridge in a pear tree. But enough about Gates. Is the Buffett indicator still relevant? Should it be setting off warning signs? Should we diversify out of stocks and go to more cash and physical assets? Well, arguments can be made for both sides. On the one hand, this has been a fairly reliable long-term valuation metric over the last 50 to 100 years. And while it's not going to nail the top or get you in at the low, it does identify areas where stocks are by and large undervalued or overvalued. Critics, on the other hand, would say it doesn't account for changing economic dynamics. Factors like globalization, where multinational companies are generating revenue outside of their home country's GDP. Technological advancements, of course, like the internet in 2000 and AI now. Potentially higher corporate profit margins could justify a higher ratio on the indicator. It also excludes non-equity assets. The indicator doesn't consider the state of other asset markets, which can vastly impact these valuations. And even Warren Buffett, who of course designed and popularized this indicator, has acknowledged its limitations, stating that no single metric provides complete picture of market valuation and that its relevance can vary depending on the context. In other words, sure, it's worked a couple times in the past, but is this a metric you want to base your financial decisions on? Is one number, one line on the chart enough to take you out of stocks, especially in such a historic bull market? We have massive foreign investment coming into the U.S., we have inflation largely tamed. We have interest rates expected to be cut. And we have hugely increasing worker efficiencies thanks to ever-evolving technologies like AI. So me, I'm still invested. I'm still 100% long. But what about you? Tell me your thoughts on the Buffett Indicator below. I'd love to hear your feedback. And if you haven't already, click the subscribe button down there in the corner. That way you'll get this content in your feed on YouTube and you won't miss another update.